April on Wall Street is over, and the bulls kept running through the tape on the final trading day of the month. Today, the Dow finished up 250 points, closing out the month up 2.5%, with the S&P 500 giving us 1.5%, and the NASDAQ closing just slightly in the black. Will the good times last? Well, we're here to answer that question for you. Welcome, everyone, to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in sunny and hot Scottsdale, Arizona.
And much less energetic, I might add. It's been a long week, so I'm not going to be able to do your radiation treatment there.
There you go. Well, I got to tell you, Toby, you missed the last show that we had with Henry Weingarten. And boy, was he pessimistic if you haven't heard it already. But we had more people that had sent us notes wondering if you were okay. They wanted to know, where was Toby? They were very worried. And I kept saying, Toby's a businessman. He's doing business. And I could see why you're a little bit worn out today. But
he's a business man. He's a business man.
Yeah, that's right. That's right. He's making money moves. That's for sure. But here we're going into May next week. We have a big Fed meeting. You got the jobs report. We still have another 50% of S&P 500 companies to report their quarterly earnings. Toby, I got to tell you, I know you might be a little exhausted now, but boy, when we get up to Memorial Day, I think you're just going to be snoozing for a while. But what do you think about this market?
Yeah, it's so interesting, Todd. I swear, like I'm OG. I pull out some articles from the Wall Street Journal. I just put one stack. So this is just positive news. The other stack is negative news, right? Now my third stack is AI, because we're making a shit ton. That's a technical term on Wall Street of money in our AI stocks. But I just think no one has been through this. There is no analog, no model that says, okay, wait a minute, we come out of a pandemic that went into a recession that we threw $7 trillion at, that then expanded the economy again. Then interest rates have gone up 5% in 12 months. Never had that. And then then we have an invasion, and then we have another invasion, and then we have China, and basically United States now in a Cold War. It's not even a hi, how you doing? China is opening. It is reopening. That should be stimulus. Well, what are the worst stocks this year? Chinese stocks.
Yeah.
I mean, there's just there's just no, consistency. And so therefore, when all else fails, what do people do? Let's buy the big mega cap stocks. So this number really got me today. The 7 or 8 mega cap stocks, depending if you throw Walmart in there, but they're not really a tech stock, are responsible for that 94% of that S&P 500 gain you talked about.
Yeah.
If you didn't have that, if you didn't have those, then you'd have a negative 3.5%. So clearly, listen, man, when I had a hedge fund and had a mutual fund, when you're just confused, buy the big freaking stocks, just hide, and the overall market, if you take the PE, the price earnings ratios, they're at 18, 19 times. That's the high range of typically, historically 16.5 is the multiple that we trade on. Yeah. So now if any of those guys would have missed this week, we'd be down for the week. But obviously, they have these great business models that continue to repeat. Facebook ads were up. Microsoft, adding AI gave it a shot. But the one that really got me was the number of $250,000 to $500,000 a year jobs have been cut in Silicon, not Silicon Valley. And it's now almost 220,000. Now, why that makes a difference is that, I don't know if you know this, Todd, but the actual average salary in the United States for someone who's working a full week is about $48,000 a year. These guys are 5 times or 10 times more in salary. They're getting compensation packages. But then today, on the labor report, it came out and said there's more people who used to make $250,000 that are now accepting $100,000 jobs. So this is like the desecration of the the tech worker. And oh, by the way, they're still living in Silicon Valley, where their apartment costs them $5,500 a month. Their auto insurance costs them. They live in almost a 20% tax rate when you add it, at the high end. So
Yeah.
We're not on life support. The interesting thing today also was looking at the consumer. The consumer actually increased spending 3.3%. If we didn't have that, then we'd be already in a recession. So
yeah.
So I don't know. I'm getting dizzy just counting all the contra indicators, positive indicators, negative, and that's where I think the market is. I mean, go buy the QQQ. I have a friend who he's an old football player, and I know when the world is coming to an end because I already have sold his QQQs for him. And then he says, well, are we going to buy the QQQs again? Yes, we're going to buy the QQQs again. So we did like in March. And, he's up wahoo, like 4.5%. He thinks he's over the moon. But there's a lot of people like that who just said, and then the other thing, that stopped me before I kill myself here. But did you see how much money went from Schwab's like cash account to their 4.5% treasury? I mean, that's what's wiping out these, FRC and all these other guys is that you have to pay, you have to have a mutual fund or an ETF that's paying that 4.5%. And now you have zero risk of loss at this point because they're short term, they're going to roll over. That's the competition.
That is. And then not only that, I mean, you take a look at any of these savings accounts, Apple's new savings account at 4.15%. Even Goldman Sachs and their Marcus online savings accounts paying 3.9%. So yes, it's difficult for a regional bank that provided loans, low rate loans just a couple of years ago. And now they're trying to compete because all of that deposit money's leaving. And we all know that story.
Yeah,
but
I wrote a piece for the Wavewire, which is now at truemarketinsiders.com. We moved our newsletters and everything else there. And I wrote a piece on this, the magic of the maturity rollover. The thing that's going to help the banks that don't have, $48 billion of 0.05% deposits, because that dog won't hunt and they're already basically dead. But the regional banks and the smaller banks that have like 1 year, 2 year paper, didn't go silly and buy 30-year T-bonds. Those are now going to start rolling over. And what they didn't talk about, the Fed didn't. You saw the Fed's report on on Silicon Valley Bank. A, Fed completely screwed the pooch. B, management had no freaking idea what they were doing. And number three, the quote unquote regulators, said the bank was fine 10 days before they crashed. So that is a giant FU. And you saw this week when First Reliance just took another nosedive. That took the market was up that day on Tuesday, remember? And just that fear of contagion. So there's real palpable fear in this. That's not over. There's going to be some, dead fish washing up on the ocean at banks.
Well, it seems like a lot of strategists right now are predicting more pain with the regional banks. I mean, and it's First Republic you're speaking of. And yes, we saw that today, and where bankers are actually saying, look, if you're not going to save us now, you're going to have more pain down the line. But they cannot be the only regional bank that's going through this. I think there's going to be multiple stories. These situations always seem to go in waves, and here it might be a lull for maybe a week to 10 days, but then you're going to have something else that happens, especially if the Fed does hike another 25 basis points as will. The markets.
Fed futures have priced that in. The question now is June, which comes in pretty quickly.
Right.
But I always want to step back a little bit for people to understand that since the Fed, they say they have tools, they only have one freaking tool. Well, they have two tools. They can buy a whole bunch of dollars. They can do this quantitative easing where they just buy a whole bunch of like trillions of dollars of bonds from banks. Now the banks don't have the bonds, but they have cash. It's always intriguing that most people don't know that cash was actually just created with a push of one keystroke, and the Fed, who runs the money supply, just pushed $4 or $5 trillion of cash that had to go somewhere. So that stimulates the economy, right? But the way you destimulate the economy, no one's ever talking about now, is quantitative tightening. So every month they're rolling off about $800 billion of all this liquidity they put in there. That has a very long lag effect. And since they really only started, it's hard to believe this, isn't it? They only really started last, March, April of last year.
Yeah.
We don't know. We've never shrunk the balance sheet by trillions of dollars, a year or even a quarter in some cases. We don't know that. They got 115 PhDs there. I've been to the office, one in DC and in New York. These are the pointy-headed nerds you've ever seen in your life. Now, 150 PhDs couldn't model what's going to happen to the economy when you pull that cash out.
Right.
That's a little shocking.
Well, it happened so fast. I mean, we raised rates at the fastest pace in history.
But
And
that's the job, though. That's the only. I'm trying to say that's the only tool they have. But it takes 9 to 12 months for stuff to break. Meaning that just like SVP, just like the credit standards in the national banking system are tighter by almost 40%. I mean, if you're a business guy and your FICO score or your business score was, let's say, 700, unless you're 750 or 800, your loans are not going to get renewed. You're not going to be able to get new expansion capital. So it does slow everything down. It's just that it's the services that's where the inflation is. And the services will not come down because the biggest part of that is housing and rent, and all this housing equivalent. I love rent equivalent. They call 2,000 people every quarter and they ask them, what could you rent your house that you own for? And that's how they come up with this rent equivalent, which is, can be totally insane. Why don't you just go to, to one of the online companies, to Open Door or so on and so forth. They'll tell you what the rents are. But that is still can't come down till October at the minimum because it's on a year-over-year basis. And so we're going to have that service inflation elevated, my favorite term now, elevated, other words for high, for a long time. And that's not coming down. So market, look at this week. This week was a dichotomy, or it was a conundrum wrapped around a riddle. Tuesday, all things great, and then the bank boom. And then 2 days ago, and then Microsoft comes in with that big number, and Microsoft in the S&P represents almost 12% of the whole freaking thing. If Apple comes in next week and beats it, I would be surprised. But if Apple, beats, then again you're going to have this 2% rise, and then somebody else is going to come out and say, oh yeah, we're missing our numbers. So
close to half of the QQQ actually consists of just two stocks, and that is Microsoft and Apple.
Yeah.
So so if we do get a big beat,
so we're long.
From
By
Apple,
the way, we're long that
happens.
TQQQ. It's an ETF that's a double 2x of the Qs because that's the barbell. It's a really skinny barbell. This is the barbell that's the TQQs, and then this is all the high dividend reinvesting dividends, just growing wealth every month because you're reinvesting dividends. And then we have some real micro cap stocks that I can't talk about that are freaking kicking ass. That's a scientific term.
Yes, it is. And for the audience also, on that 2x that Toby's speaking about, that actually means it has a beta of 2. So if the the NASDAQ goes up 1%, QQQ should rise 2%. So the inverse of that is also true. If it goes down 1%, could go down 2%.
Exactly.
Just something to keep in mind. So just something to keep in mind.
Well,
but let's
go ahead.
Well, I was just going to say, let's close it out on this block because coming up, let's talk about those tech earnings because I'm really surprised with some of the results that we are already getting and what maybe we should be able to expect going into the month of May. So please stay with us on Buy, Hold, Sell. We are back today. It is the last trading day of April. We have so many good things to tell you about as well. So please stick with us after the break. We'll be right back.
Hi everyone, I'm Veronica Dudo, and welcome to Buy,
Hold, Sell. If you have the Russians that are going into Ukraine, the Americans and the Germans and everyone else in Europe is going to say, hell no.
If Russia doing things, logically was their MO, I'd agree with you. Yeah, Todd, why don't you get him on a phone call right now? Hello.
Financial News TV, just the way you like it. Fast-paced, unadulterated, in-your-face, rock and roll style. Join us next time on Buy, Hold, Sell Live.
Oh, yeah, I'm going to remember all that. I can't even remember.
Oh, God.
That doesn't. I want you to, oh, my God. Fast-paced, no. Oh, sorry.
Take one.
fast-paced, no holds barred, in-your-face rock and roll style.
Woohoo!
Good sign.
Let's kick some
Welcome back to Buy, Hold, Sell, where we saw the Dow close out the month of April on a very high note, with the Dow closing up 250 points, up 2.5% for the month of April. S&P 500 up 1.5%. Things are looking good, and Toby and I were just talking in the last block about the quarterly earnings period, but also maybe some headwinds. But Toby, let's go a little bit deeper into that quarterly earnings period. We are just a little over 50% of S&P 500 companies right now have reported, and 80% of them have beat. I mean, it's incredible, but that seems to be typical of the 3-year average. But if we are in a recession, or if we are headed into a recession period, then how can this be? I mean, how is it that these earnings are doing as well as they are?
Well, I'm just going to go back to my basic theme of is who the F knows, right? In other words, for every yang, or there's a yang, young, whatever, there's a yin and a yang. For every positive note, you can talk to, or somebody makes a very strong case that note is malarkey, and here's the real deal. And again, we're just uncharted water. So one of those things is sentiment. And, sentiment in the short term drives stocks. Well, here's a shock, Todd. If everybody's wrong on their estimations, then they were too bearish. Their sentiment was too low. And now they have to cover their short covering, or they just, have to put money to work to try to keep up with the Joneses. And sentiment has been very, poor, because inflation, I've said this 1,000 times, here's 1,001. The Fed can't just come out and say, here we are at 2.8%, 3% inflation. We're just going to raise our target to 3%.
Right.
They can't do that. And the reason why they can't do that is they could do that if we, the United States, own the majority of our debt, but we do not. China does, Europe does. Christ, even Russia still owns almost $1 trillion of US treasuries. So if all of a sudden their credibility goes to heck, then they're going to sell that stuff. And then you want to see bonds at 6, 7, 8%. That's what's going to happen. So as I said, they've always been stuck in this box. They got a little bit of a break because the consumer, hit this 3.3% year-over-year growth. That would take away part of the recession story, since 72% of our economies is the consumer.
Right.
But it's I don't know, for people at home or seeing this video, it's not going straight down. It's like landing that jet for the last half a mile. It's sort of getting down. The Atlanta GDP, which Atlanta does this now GDP thing, which takes coincident data, not the trailing, not the future, but the coincident stuff. And they have the quarter now at 1.6-1.7% GDP. Well, that's a hell of a lot lower than when we had these 4% GDP growth. But you got to throw those numbers out. I mean, I think that's the other thing, Todd. Is just you have to throw out the pandemic numbers. You have to throw out, because there were a history of one. You have to throw out the bounce back, because I don't think we're going to be throwing $7 trillion again into the market, particularly if Kevin McCarthy has his way. And now we're heading into this June period, and I don't know if you remember it, because I don't think you're old enough, but the last time we had this showdown where the Dems and the Republicans couldn't come to terms with it, market went down 21%.
Yeah,
because default was, S&P put default risk
right.
out.
I do remember that.
Yeah, right. So the next sort of hurdle is our dysfunctional political and system, and our.
But that's a late summer story. So it is there, and it's a ticking time bomb. Let's be honest, but it is a late summer story, and we'll see. As well as I do, Toby. Nothing's going to happen until the very final second. It's going to be a headline.
Well, that's the best. But remember, the last time we did that, the Dems had the House and the Senate.
Good point.
This time, the Republicans have the House, and Kevin has got. I mean, I've known him for a long time. He grew up in Bakersfield, California, and when I worked for Fox, I'd have a cocktail or two with him across at the Jefferson Hotel across from the White House, and he's really not a dick.
Yeah.
But he comes off as just a dick, and he has to, because look at who voted for him. He's even got the gay non-Harvard graduate from New York who was the final vote for him to get the speakership. And in his speakership, they put in a clause that says if 51% of the caucus says adios, he's out. Adios. And he's been working for this job, Todd, ever since I've known him, since 2000. He hated what's his face, Patrick, who the last Speaker of the House was. He just hated him because he was too nice.
Well, but we'll see. We'll see what happens, and obviously we're going to have dozens and dozens of shows leading up to that, including our political show, Power Hour. But we'll talk further about that. But I think if the theory holds true, when you are, and I want to ask you this because it seems that if we are heading into that recessionary environment, it's companies that are of the old guard that seem to be of favor. For example, through this week, we've seen Hewlett-Packard, Microsoft, Intel, Dell. These are old guard tech stocks that are doing sensational year to date. Whereas when you look at some of the, the high flyers, those meteoric ones, the shiny ones, the fresh ones, those are the ones that are struggling. So it's almost as if we are going into that recessionary period, look at the old guard companies, because those are the ones that are going to survive because they've been through this before. Well, but what are your thoughts?
Yeah, I mean, they have. And number two, Amazon was interesting because this is the first time AWS, their cloud service. I don't think people understand that from the actual cash flow, that about 85% of their positive cash flow comes from AWS, because they were the first guys to make this cloud service.
That's right.
And
it's a cash cow.
And they get paid per use. In other words, it's not like a rent. It's you get paid how much you use it. So they actually tipped. The issue that I'm most interested in right now is I remember our CEO at Philips in 2000. And we were just kicked ass, and I had a brand new Mac computer because I wanted a Mac computer. They were all PCs there, Todd, but I wanted and I'd made the most money for the company, so I got me a $5,000 Mac computer, right? And then
make you happy.
And then about a year later, he says his name was Bob King. He says, "Toby, you son of a gun! Now everybody wants a freaking Mac computer, and they're not getting them because." You don't sell a lot of financial newsletters when the market tanks, 53% like it did then. My point is, we're tightening the belt. There's some CEOs that never tightened belts before. I mean, if you were the business, if you're a CEO from 2010 to 2022, you never tightened your belt. You had like a little pandemic disaster, but that bounced right back. So, and I think the other thing that just got me was this thing about, it was in the Wall Street Journal today, about how the $500,000 a year Google employees and Apple employees and et cetera, they're the ones who are getting cut finally. I have a close friend who sold his technology company to Google, and he's been working on their AI stuff. And I was chatting with him as the caca was starting to hit the fan. And I said, "What do you think, Roy? What do you think the odds of you, getting laid off?" He says, "Oh, 98.8%. Because his benefit package, everything else, he's getting paid $750,000 a year. That's like now that's like 5 engineers, and he wasn't really getting any headway. So I'm sorry, but I've had these meetings, and the CEO comes in and says, "All right, Toby, you're running the newsletter business here. You have 63 employees. You need to have 35 employees. So you make the decision." But this is not, you can beg wherever else. This is how it is because our revenues are down. We're not in the business of losing money. Well, now multiply that conversation over, 10, 15, 50,000 companies. And then here's the bizarre part. I'm talking with a guy, I'm down in Fort Lauderdale last week. As you know me, I'm Chatty Cathy, and there's an upstairs bar with a pool. So where I am,
What, were you there for work or was this personal?
I was there for work. We did new commercials. I did 3 infomercials. Oh my Lord. You're gonna be tired of seeing my face. Anyway,
never.
I'm up there and I meet a guy and his wife, and they're from where I grew up in Southern California, and he's a home builder. And he says, well, we're taking a cruise. We're taking a 2-week cruise. You know why, Toby? Because there's no freaking way. I have a backlog of almost 3 years of custom homes. And there are not nearly enough carpenters, pipe fitters. No one will do roofing work except for Hispanic immigrants, because they're the only people that will do that work. And so he's already sold the jobs. He can only build them as fast as they get. He's got a foreman who says, I'm taking a cruise. I mean, I made a jillion, money during the pandemic, et cetera. But so take that and multiply it all over the United States. Take, that we still are in this conundrum where we have growth, like in the solar energy business, right? We have $760 billion, right? Plus about another $2 trillion of loans and debt, green bonds. Nobody knows how to put a freaking solar thing together. Nobody knows how to put a windmill. I mean, there's not enough, nearly enough. They're down 50%. So they can build all this stuff, and our GDP would be rising, because those are big ticket items. I mean, these are billion-dollar deals. But there's not enough skilled labor. And I'll just end this rant with this. It was interesting talking with some economists I was with in Fort Lauderdale as well. And they were talking about, I know, this is the 2 cocktail truth serum. Would you pay $250,000 again to put your kid through, Ivy League school? Not even Ivy League school. I mean, Cornell, which I guess is an Ivy League school, right?
It is.
It's
a tier.
Yeah,
tier
you know
2,
you're Ivy League, because you're an Ivy League guy, but I'm not. All right.
Yeah.
State educated. But and they said no.
Yeah.
I would have them apprentice as in plumbing, air conditioning, HVAC, etc. He was saying he had 800 square feet of new tile that needed to be put into his house because he had gotten hit by the hurricane, so on and so forth. And he said the bill was $17,000, and he bought the tile. That was the labor.
Yeah, that's
right?
crazy.
So that's going to be interesting to see, because we've certainly hit peak tuition. They're not coming down very much.
No.
And why not, have one of your kids, once they get done with their professional careers, playing highlight? What do they play? I can't remember again. Oh yeah, lacrosse. Isn't that highlight?
No, I don't know what that is.
Oh, it's highlight for young white kids. That's what it is. Okay. And yeah, in Miami we have the highlight stuff that I was at.
Oh, okay.
All right, but I don't know. I mean, now I have another friend whose husband is Dutch, and they have 2 young kids. And again, 2 cocktail syndrome. She says, well, our kids are going to college in Holland, in the Netherlands, because it's $1,100 a year tuition.
Yeah, it's crazy.
And these are world-class schools too. This is not like you're going to the JC. So so that's that's what worries me about us as we get through this rough patch. We're the people.
Well, I mean, I'll give you an example. So you and I, we've talked about this before off air. My son, he wants to be a pilot. So he's going to go to college to be a pilot. In addition to his tuition, though, the flight costs just to study this is $200,000. I mean, who's going to be a pilot? No wonder we don't have any pilots. Plus, because of the likes of Chuck Schumer, now with the regulations, just the amount of time that needs to be spent just to practice flying.
You mean the air time that they have to put
the
in?
Air time. Yeah, the air time. So now because of that, now you have the costs and the time. That means you're not making money, doing anything else. No wonder we don't have pilots. So that's great that he's doing that. But the amount of money that's spent on it's like it's almost like you're going to be a doctor. You're going to med school.
Right.
And this is to fly planes, fly people around from Minneapolis down to Orlando for Disney. It's crazy.
Now I get it. That's why we have all these ex-Air Force, ex-Navy pilots as pilots, because they don't have to put that time in, I assume.
Well, there was a crash actually that happened in Western New York years ago, and it was pilot error, and I forget how many. It was a fatal crash, and but the pilots were fairly new, and so Chuck Schumer, Senator of New York, he led the charge to say, look, you got to have X amount of hours of training, which is right. It's a safety component, but as a result of that, it's just there's so much there, plus the money that's involved it's very difficult just to get over that hurdle.
And the
That's one.
the airlines don't give scholarships out or something. I mean, the big ones don't.
They don't. But what's funny now is my son who's in this program, it's at a school in the Midwest. It's a 13% acceptance rate. Truly remarkable. He's in there.
Yeah.
He's actually been getting inquiries from the big airlines now to say, look, we'll train you. One of them is actually down by you right now in a major carrier, and they're trying to get him there and saying, forget the college, come here and you could just start flying for us, or we'll train you.
Well,
and we'll pay for
at
it.
least that makes some sense.
But then you lose the education part of it though. So that's something, it's a decision.
There's this thing called Coursera, right? You can take every college course online while you're flying. By the way, my two pilot friends who fly the big jets, and they do one, we'll just call one Tom K. Tom K,
Mm-hmm.
you're the pilot, you're the guy taking the plane up. Yeah. So we get
Mm-hmm.
there about a half hour before, we check everything else out. When do you hit the autopilot? He says, well, actually about 45 seconds after we've taken off.
Wow.
It depends where depends where they're doing it. But he says as soon as we get to the altitude, it's autopilot all the way. He goes back, talks to the hot looking girls, and because if you have the uniform, you get the hot looking girls. But
you are right though. The tuition costs, people are being priced out of it. So to learn those skills, plus we don't have enough humans that can actually take care of all of the work that's out there right now. It's incredible. You and I, as busy as we are, Toby, think about this. We are remarkably busy, but I'm sure if we were cornered right now, we probably couldn't hire 10 skilled people right now to do the work that we need, because they're just not skilled. It's just not skilled labor, or if it is, it's going to be tough to find. You got to pay a premium for it, et cetera, et cetera. So there's a
little bit of a tangent, but it's a microcosm of the United States right now that we can't grow in the manufacturing side. On the service side, we're also peaked on that because we haven't had the normal legal immigration. So we're down 3.5 million legal immigrants who, I don't know about you, but when somebody comes to clean my house or clean my pool, they are not, hi, I'm Bob, I'm from Cornell, class of 22.
Right.
So in the Scottsdale area, in Arizona area, let's just say they've had more immigration than maybe the numbers actually say. But you can hire somebody, but everything is freaking expensive. Everything is freaking. They used to clean the house for $150. Now it's $250. And if you don't like the $250, great. I got a waiting list for people. So it's
crazy.
So that's going to put a ceiling, I guess, trying to say, on our GDP growth. And then with the Fed, withdrawing it. And by the way, the data that I see and the numbers that we run says that with the credit raising, or the credit score to get a business loan or expand a loan, et cetera, has gone up so much that the Fed even says that's probably like 0.5% of tightening, simply because of the credit tightening, and that just started. So I think, I don't know, I've sort of gone into the camp that because the Fed was so effed up to begin with on the, we're just gonna have this transitory inflation thing. And they had no model that said, well, what happens when we have a pandemic and then you put 7 trillion in, they were just winging it. I think now, I would say that a recession, in other words, 2 negative quarters of growth, is more like the fourth quarter this year, first quarter next year. The question is that priced into the market? And the answer would be, well, not if we're selling at 18 or 19 times, 2024 earnings estimates, because that's the high end. Normally, when you say it's priced in, that means you price down at least to the average for the last 30 years, which has been about 16 times, or maybe even price lower. Well, we've got down to about a 14 PE, in the market, tanked. But now we're back at 18, and tell me what's changed. I'm confused there. I think the Fed is they didn't know what they were doing going in. They're not, don't know what they're doing now. They're flying by the seat of the pants with 115 PhDs doing God knows what there. They're probably playing pinochle all day. And they're going to break it. Jay Hatfield, we'll have Jay on a show here in a little while. He's the general partner of AMSA, which is an MLP ETF that we use. and PFFA, which is preferred. And, you know, he grew up in Palo Alto. He's a Stanford kid. He's a snot-nosed Stanford kid, but and he's my age. But he, so he's still a snot-nosed kid. But he has been right on this, that, you know, his bet is that that too much is broken underneath the surface, and the Fed's been too high for longer, and they're on a sort of kamikaze run, and they know they're going to break stuff. Well, guess what? They just broke, you know, the 12th largest and the 18th largest bank in the United States. And since the regulators just said they had no clue, the Fed said they had no clue about this, I can't really say that all of a sudden they're going to see, you know, the light and, oh yeah, now we understand how this works. So anyway, I'm just saying, I would not be at home, you know, reinvest your dividends, have your high dividend stuff, make sure you have that 4.5% money market fund, reinvest that, keep your risk, you know, very moderate here, and let's get into June and see, and then let's get into this freaking debt crisis, because yeah, everyone is saying at the end of the day, the hue and cry from the masses is they're gonna get them in a room and get the club and beat them over the head and say, you guys, you know, agree. But now with the political polarization, you're now rewarded as a Republican to be the hard ass. You know, this is just like, remember those tax guys, the back in to 2010, the tax revolt guys? They elected about 8 people from that craziness. And it wasn't that they were crazy. It was just that they didn't know what they were doing.
Yeah, Tea Party people. Yeah,
Tea
no,
Party,
you're right.
Yeah. I remember I spoke at the first Tea Party thing in Washington D.C. at the park across the street from the White House, and there was all these people dressed up like Paul Revere, you know, and then they had these signs, and the sign says, "Cut taxes, but don't touch my Medicare."
Yeah.
I said, would you bring that sign up here? And they were like, you know, filming this for the news. And I said, these two statements don't make any sense.
Yeah.
Where do you think you get the money to pay the Medicare? Are you? And then if you're going to cut taxes, you're going to keep Medicare, then we're going to run those deficits, which you're protesting about, you boneheads. Don't get me started.
That's great. I'm not going to get you started. Well, listen. Let's end the show on that note, because we're going to continue. There's so many things to talk about. And I know over the next 4 weeks, we have plenty more, including the fact that starting in June 1st, CrossCheck Media will have its own network on Apple TV as well as Roku. And what that means for you is that you're going to be able to watch Buy, Hold, Sell live right on Apple TV.
Live,
as well
or
as Roku.
you can stream it.
Or you could stream it, whatever you like. So you can watch it live. The whole gamut of shows that we have for CrossCheck Media are going to be available to you. And look for lots of press mentions.
Do I have to wear a
tie,
Todd, or can I just still wear a white shirt?
You know what, Toby? You always look good. It doesn't matter what you wear. So, you know, you wear whatever you're most comfortable with. That's all I'm going to say.
Todd, I'd like you to, after the show, look up the word sycophant. Okay, you are fantastic.
Outstanding. Absolutely. So listen, check out Toby's writings at TrueMarketInsiders.com. Go to TrueMarketInsiders.com. Toby has been on fire. You got to read his knowledge.
Our new newsletter launches, I believe, May 10th. And we have like a special for, I think, like $79 for the year.
Not bad.
And just our AI picks are, in my mind, these are 10, 20x type winners. Just the AI picks are worth the $79. And oh, by the way, after 30 days, if you don't find value, we give you your money back. So it's a sort of no-risk deal. But it's at these times when we do make money, you know, when people are confused and so forth, that's, you know, when we make the biggest money. And so I'd love any of the viewers to come in and join and get on the deal, because the price goes up after that.
Absolutely. And you know what? I mean, it's a drop in the bucket for the amount of value that you get out of something like that. So definitely everybody should check that out. Absolutely. So
I apologize for calling you a sycophant.
Well, we got big shows coming up for you in the month of May. We have some all-star guests that are coming up. We will be back on Buy, Hold, Sell. It's great having you. Thank you so much for joining us today. So on behalf of Tobin Smith, I am Todd Schoenberger. Thanks again for tuning in. We'll catch you next time. Take care.
I want you to smash that like button.